Have you ever looked at your paycheck and wondered how the Canada Revenue Agency always finds a way to take more every year? You're not imagining it. Taxes are complicated, and without a plan, you'll always pay more than you should. The good news? There are legal ways to keep more of what you earn. These aren't loopholes or shady tricks. They're strategies that wealthy Canadians and business owners use every single day. Let's break down 3 of the most effective ways to pay less tax in 2025. And then I'll share one bonus strategy the wealthy use to control when and how they pay taxes. First, here's why 2025 matters. A few major tax changes kicked in this year that affect everyone. The lowest federal income tax rate dropped from 15% to 14%. But since it applies for only half the year, the average family saves around $650. The bigger story is the alternative minimum tax, now at 20.5%. It limits deductions for higher earners, making it harder to reduce taxable income. On the business side, provinces like Nova Scotia and PEI have adjusted corporate rates and limits to support small businesses. And importantly, the capital gains inclusion rate stayed at 50%. The government backed off, raising it for now, which changes how investors should plan their year. Strategy 1. Maximize your registered accounts. That means using your RRSP, TFSA, and FHSA. An RRSP lets you lower your taxable income now and pay later, ideally when you're in a lower bracket. In 2025, you can contribute up to 18% of your 2024 income, capped at $32,490. That could save you thousands this year. A TFSA, on the other hand, lets your money grow tax-free. The 2025 limit is $7,000. Investing that yearly at a 7% return could grow to around $138,000 in 10 years, without paying a cent in taxes. The FHSA combines both benefits, RRSP-style deductions and tax-free withdrawals, ideal for first-time homebuyers. Strategy 2. Incorporate your business income. If you're self-employed or run a side business, a corporation can save you serious money. Corporations pay much lower rates, around 11 to 12%, on the first $500,000 in profit. You can deduct legitimate expenses, mix salary and dividends, and defer personal tax by leaving profits inside the company. A consultant earning $300,000 personally might pay $120,000 in tax. Through a corporation, that drops to roughly $36,000. The rest can be reinvested for growth. Just keep receipts, logs, and clean records to stay CRA-proof. Strategy 3. Use real estate and capital gains wisely. When you sell your main home, any profit is tax-free under the principal residence exemption. Rental income is taxable, but you can deduct mortgage interest, repairs, utilities, and insurance. Timing matters. Selling during a lower income year or spreading out capital gains can save tens of thousands. And here's the bonus, the holding company strategy. Set up a holding company that owns your operating business. You can transfer profits tax-free between them, invest the money, and choose when to withdraw personally. It's 100% legal and CRA compliant. You decide when to pay taxes and protect profits while they grow. So, to recap, 1. Maximize registered accounts. 2. Incorporate for flexibility. 3. Use real estate strategically. And 4. Consider a holding company to master tax deferral. The CRA plays by complex rules, but once you understand them, you can finally use those same rules to your advantage.